Everybody wants to know, what are the signs? When am I going to know that the whole thing is coming down? Well, let me tell you, I'm seeing those signs. I don't like what I see, and we're going to talk about that today coming up. I'm Lynette Zang, Chief Market Analyst here at ITM Trading, a full-service physical gold and silver dealer specializing in custom strategies, and I sure hope you have your strategy in place, because what I'm seeing is not a pretty picture. And when people are asking me, how close are we, I can't tell you the exact second, but in my opinion, and from what I'm seeing on a global basis, the implosion, the loss of choice could happen at any second. Let me show you what I'm talking about. Because what everybody wants is that soft landing that the government and the central banks have been telling me that they're going to try and engineer, even though they've never done it in the past. And all they're doing now are more experimenting. So, I'm sure we're going to get that soft landing. So what exactly does that mean? Well, that means that employment goes up because more people are coming in to the workforce than people losing their jobs. Oh, isn't that great? And therefore, more people coming in have less ability to demand more money for their work in this environment. And here's John Paulson. You know, what is he saying? Frothy U.S. housing market, but this time is different. Maybe. But quite honestly, since the same thing with the currency life cycles have happened well over 4,800 times, and we are doing the same thing, well, what did Freud say? Insanity is doing the same thing over and over again and expecting different results. But hey, in the subprime era, financial system is not as at risk. That is garbage, garbage, garbage. Because what happened in the subprime crisis was that liquidity dried up. And I've been showing you over all this time that there are some serious issues around liquidity, particularly in the U.S. Treasury markets, but in all government debt markets, sovereign bond markets. Real interest rates blamed for lackluster gold price, because in theory, you've got fiat money, which is, that one doesn't work. Nope. One side of the coin, and then you have good money gold. That's the other side of the coin. So if the dollar gets stronger, like we've been hearing so much about, then in theory, gold would get weaker. And if the central bank will pay you more, so pushing up interest rates, well, after all, gold does not pay any interest. So again, what I say, garbage, 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 because the entire system has been turned into a Wall Street fiat money product, including gold on the spot market, except that gold is real and used in many other places. We'll talk more about that. So the question is, and you really need to ask yourself this, do you really think that this time is different? Because I don't think it is. And what I'm seeing tells me, no, this time is not different. And it will absolutely be the lack of liquidity in these markets and then that trigger those derivative events. And there's no way central banks can print their way out of that, period, end of discussion. And the truth is, at ITM, we have a plan. But hopium is not a very good plan. You can hope, you can wish, you can pray, and that doesn't change a thing because these guys have corrupted and convoluted. But what I love is, we have a strong dollar, and after all, it's up against every single major currency today. That was yesterday on September 26th. The dollar doom loop rolls on. Well, what's the dollar doom loop? Right? The stronger the dollar gets for those foreign currencies that entities, governments, and corporations that have borrowed in terms of dollars when it was a lot cheaper than it is today, well, they have to repay that debt and those interest payments in terms of dollars. So these governments and corporations have to go out and buy dollars, making it a whole lot more expensive for them to service that debt. So that's what the dollar doom loop is all about. And let me tell you, the stronger the dollar gets, my guess is that it's probably going to end up going to about 120, which would be a resistance level, before coming back. But I want to show you a little bit about the dollar before we move on. Because back in 1971, this is when the debt dollar was born. So the currency was no longer backed by gold, but by debt, the ability to grow more debt. And as you can see, we're just a little bit above where that is. We're basically where the dollar originally came out of in 1971, which I think is really interesting. This big spike up here was when Paul Volcker raised the interest rates intraday to 21.5%, giving them a lot, meaning the central banks, giving them a lot of interest rate ramp room to drop interest rates every time we went into a recession, which then would inspire borrowing and spending. Okay, and you can see, I also want to show you this. So in 2002, this, if we go to where we are right now, or where we were yesterday at the close, 114.29, we're pretty darn close to the highs last seen in 2002, before we went into the low. Oops, my animation is acting a little bit funny. But 2007, depends on how long you've been watching me. But once the dollar fell to those new lows, and you can see that is a brand new historic low that it fell to in 2007, that was the signal to me that we were in deep doo-doo. And what I said then, if you were listening to me, I said something really nasty this way comes. Everything looked great at that point if you were looking from the outside and just staying on the outside. Looking at the inside, you knew something really, really bad was coming. And obviously, the crisis, the financial crisis that happened 2007, 2008, we were told. And the thing is that you have to listen to these patterns and you have to listen to these signals, because they don't have any emotion around it. They're much more clear on what's about to happen. But the reality is the higher the dollar goes against other currencies, not in how much you can buy with it. We don't have a strong dollar. We have inflation. That is a weak dollar in terms of purchasing power. So don't be swayed when you hear, oh, the dollar is so strong. It's just relative to other currencies. And let me show you how that really plays out and why the dollar has gotten so much stronger. Because the Fed has been raising interest rates. So again, as the Fed raises interest rates, it makes it more attractive to buy dollar-denominated assets like bonds and things like that. And that in turn, people see that, technicians see that, then they go, oh, well, the dollar is going to go up even more. So let's buy into it. And let us not forget the derivatives markets, because they play a huge part in it. It is so much cheaper to buy a derivative against a stock or a bond or gold or anything than it is to actually buy the underlying. So you can see this is the US dollar index. And I just went back a year on this or so, prior to October 2021, maybe a year and a half, 2 years. And this is the 10-year Treasury Yield, which actually this morning when I was looking at was at just shy of 4%. It makes everything look more attractive because it pays interest. whoop-de-doo. If you can't use it to buy any goods or services, you can have, look at Zimbabwe, you can have $1 trillion, but you can't buy 3 eggs with it. That's that nominal confusion that the central banks use so that you don't really understand what's going on as you lose purchasing power, which is far, far, far what happened. Far, far, far more important than how many you have. It's what you can buy with it. So if you borrowed anywhere in here, or as you saw in the earlier index, and you now have to service that debt, that is a huge problem for you. And just as a quick little reminder, here's the purchasing power of the dollar. Does that look like that's getting stronger to you? Hello. And this is from the Fed, so you even know that it's garbage. There's less than 3 cents left in the original dollar officially. And then this is the PCE, personal consumption expenditures, which is what the Fed really looks at, or they say they look at. You know, I mean, the Fed really has no idea what's going on in the real economy. They live in their theories. But what I found particularly interesting about this is that they haven't updated the PCE since July. Why not? That's a monthly index. And we're in what month now? Oh yeah, we're about to enter October. We should have those numbers through maybe not September, but at least through August. And we don't, because they don't even really want you to realize what's happening. And this gray bar is 2008. That's when the system actually died. So you got to ask yourself, you know, is the dollar really that much stronger? Don't believe those lies, because how many times can you be lied to when you don't know the truth? Every single time. And so we've entered a new and very, very dangerous phase where we are in reverse currency wars. I hope you have your seatbelts on, meaning I hope you have your gold and silver, because this is not going to end well. We got to talk about England, because, and hopefully I will be having somebody that lives there on very shortly. But I love this, and this kind of shows what we were just talking about in some ways. In other ways, it doesn't. It just shows what happens when a currency gets massively devalued. Bank of England's QE, quantitative easing, so all that garbage that they bought to support the economy and all that spending is $200 billion in the red after the pound's rout. Isn't that interesting? Now here you can see the red is the spot British pound. Anybody can bet against that. Traders can bet against that one way or the other. This is who's really controlling these markets. It's not a normal supply and demand market. It hasn't been forever, as Wall Street has financialized every single asset. So this is the government bond. This is the spot, and these are the yields on the 10-year gilts, the Britain's government debt. Now, I just told you and I just showed you how when the Fed raised rates, that made the dollar stronger because it made it more attractive to buy that debt. And here I'm showing you just the opposite. And the difference between the two is that that was the Fed's choice, and this is the trader's choice. Traders do not care about stability. They just care about making some money. So my question is, how will the Bank of England halt the panic over the currency, over the pound? How are they going to do that? And here's an even better question. And if what they do does not work, how is that going to impact the confidence in the pound? Because that's what this is really all about. In the meantime, you've got the population and the public over there that have really been beaten up. But, you know, I also want to make this point. I'm talking about Great Britain right now, but the reality is this is happening all over the world. And so this is just maybe a little snicker snack of what we have in store here. Now, In England, they don't have 30-year fixed mortgages. So that piece is a little different. And thank goodness we do have that here. But let's talk about what's happening there. Because what? British lenders pull mortgage deals with UK markets in turmoil. Doesn't that kind of sound similar to what happened back in 2008? Huh? When those markets boomed, 24 hours they dried up. That's the lack of liquidity. So just when they need liquidity the most, liquidity is being pulled from the British markets. This is not a good thing. And brokers said that the moves were likely just the start of a big shift in Britain's mortgage market, which, as we know, because again, this is a global phenomenon. So I think that this is just telling us what's coming to a neighborhood near you. And you really have to think about what these people are going to be doing, because they've got a new rate shock. So remember the adjustable rate mortgages? That's mostly what they have in Great Britain. The new rate shock will quickly slam millions of UK homeowners. Why? Because they have to refinance those markets into a significantly higher rate. And this is just showing you when those numbers of adjustable rate mortgages came out and as they're going to reset. So that's why they're talking about it's going to be felt by millions and millions of homeowners. It will likely decimate the Great Britain's real estate market. But, you know, the new government is cutting taxes into this and trying to stimulate the economy, as the Bank of England is doing just the opposite, raising rates to try and tamp the economy down. You see, that's the same kind of thing that's happening all over the world, where you've got the government doing one thing to stimulate and the central bank bent on raising interest rates and tamping everything down. Does that make sense to you? No, it doesn't. And that's why the more and more that I look at this, and also knowing, you know, people always assume that they want things to stay status quo. But if you have no purchasing power left and you don't have any interest rates left, because that's the tool that central banks use to regulate the rate and speed of inflation, and you've got most of the world anchored somewhere near zero. They're trying to lift off of that now. I mean, the EU just went to zero interest rates. Whoop-de-doo! That's going to fight that inflation. I mean, this is really showing you that the whole system is breaking down pretty darn quickly. 926.22 initial fixed rate. You know, a lot of these mortgages, this blue was all under 2%. And they're coming in and it's probably going to be upwards to 5 or 6 or maybe even 7%. That is huge, especially since the price that they paid for those properties were huge to begin with, right? And they have limited options. This is what I'm talking about. This is a con game. This whole fiat means by decree. This is a government-based system, and you have to have confidence in the government, in these central banks, in order for this game to continue. And with rapid inflation, if they could just moderate inflation to 2%, they got it. You didn't ask for more money when you went for a job. That's price stability. It's not that the prices stay the same, it's that you don't ask for more. And now we are looking at a major crisis in confidence. They're expecting the bond to be at parity or equal to the dollar by year end. But guess what? The euro already did that, right? So what we're really seeing is the whole pegging, the convergence of the system declining and falling apart. It's not just going down, it is actually being destroyed, right? I've talked about this too in many videos, and Angus is on camera today. Can you write down and make a note to have Edgar pull up some of the videos that I've done in the past on currency pegs? So we'll have that in the description. We'll also have that in the blog, because a lot of different currencies around the world either pegged And so they wanted and I'll show you this a little bit later, they pegged their currency to the US dollar or to the euro dollar. And now what we're seeing is those pegs are breaking. And when a peg breaks, it's violent. It's not something that is like a poof and you don't even see it. It's pretty violent. And that's why, I said earlier, everybody always wants to know what I'm looking for. Well, this is what I'm looking for. Because it's all about confidence. And if there is now a crisis of confidence and they can't pull it together, and they can't pull it together, this is it. There's no more kicking the can down the road. This is it. Because when the public loses confidence in the currency, that's when you get hyperinflation. And it doesn't matter where that starts. This will not be contained in Great Britain, which is an advanced economy. This will not be contained there. UK meltdown raises specter that bond market vigilantes are returning. And what you really need to understand about this is these trades for government debt were handed over to the traders. 2013 was a big year for the US Treasury market that it was handed to the traders. I didn't put that graph in here. If you want it, just ask Edgar and we'll put that up. But the VIX on Treasury bonds, you could actually see when it was handed over. Traders only care about making a little bit here and money there. They don't give a crap about economic stability. They only care about the trade. It totally is that accurate. And you can see that the gilts and the pounds plunge as the investors, traders, take on UK fiscal policy, because there is a huge conflict between fiscal policy and monetary policy. Like I said, governments and central banks are not working together on this one. And I think it's because they're ready for the system to collapse. Next week, I'm going to be doing the update. They finally came out with the reports on the CBDCs, which is the next iteration. So I'm going to be doing the whole thing on that next week. You definitely want to watch that because that's what they're going to move us into. UK's worst debt market collapse in decades is serving as a warning to other governments caught between surging inflation and growing recession risks. The bond market vigilantes haven't completely gone away. Heck no, they haven't gone away. In fact, they could easily, maybe not even intentionally, pushing this all over into the main collapse. And that's why I said earlier, I can't tell you the exact second, but you better be ready now. That's what I can tell you. You better be ready now, because I'm not liking what I'm seeing at all. And especially when you're looking at bond sell-off, the worst since 1949. Gosh, what was happening in the 40s? Oh yeah, Bretton Woods, when the US dollar became the world reserve currency. So you see, one thing that I find so incredibly interesting is that they will take us back to major shifts in the financial system, but they never say that, hey, this is when the Bretton Woods system, so the whole world went on a different system. We don't want you to realize that. And oh yeah, in the 70s and the 80s, we were transitioning from a gold-backed system. 1940s, we were transitioning from a gold-backed system to a dollar-backed system. Because what we do, the U.S. just promised to hold the dollar's value at $35 for an ounce of gold. And the whole world said, okay, well, we'll just peg to that system because we're so trustworthy. 1971, we went from a quasi gold-backed system because the dollar was supposed to maintain its value at $35 an ounce of gold, which clearly it didn't. Vietnam War, many other things. And we went into a full debt-backed system. What are we going into now? We're going into a full surveillance system if you allow it. It's up to us. There's more of us than there are of them, but let me just keep going here. So global government bond losses are on course for, let me just read that first part again. Global government bond losses are on course for the worst year since 1949, and investor sentiment has plummeted to its lowest since the financial crisis. That's 2008. So they're talking about 2008, when the system died. This year's dramatic bond tumble threatens credit events. That means lack of liquidity. That's what happened in 2008. That liquidity dried up just like that. It was fine, and everybody was told everything was fine. No, it wasn't really fine. So threatens credit events and a potential liquidation of the world's most crowded trades, like, I don't know, big tech, right? That would certainly be a very crowded trade. Treasuries are a very crowded trade, including bets on the dollar. Very crowded trade, as we've been talking, that have taken the greenback to multi-year highs against other currencies, and bets on U.S. technology stocks. There is a lot of pain. If you do it look, I can't tell you what to do. I can tell you that I personally do not own a stock or a bond or an annuity or any of that guaranteed garbage. Yes, I have cash because that's still our tool of barter. Yes, I still have a bank account, but I only have a certain level because I 100% know, not one doubt in my mind, that this is a currency life cycle issue. I mean, all the patterns are there, all the signals are there. You better be ready, because there are so many black swans that are flying all over the place. But really, it's the derivatives, because easily the traders could trigger a derivative event that is bigger than anything that the central banks can marginally handle. Not even sure that they really want to handle it, because if you're scared enough, you'll make different choices and they'll say, this is going to save us. And you'll go, save me, Mr. Bill. It won't save you. Gold and silver will save you. Investor sentiment, the lowest, you better be ready for this. Because even Mohammed Al-Aryan, and you know I've shown you his work before, this was just a year ago, 8/26/22, a month ago rather, and you can see how the bond market, this is the Treasury market, is shifting. It's feeling a little disorderly in the Treasury market, the market of virtually all markets globally in one way or the other. This is what underpins the entire global financial market. And he's saying it's feeling a little disorderly. What does that mean? What that means is that the Fed is losing control. That's what a disorderly market means. That the traders have taken over and they have overwhelmed the central bank. Can they pull back control? I don't know. That is yet to be seen, but I'm telling you, it's like the little Dutch boy with his fingers in the dike over and over. And, you know, he only has 10 fingers and 10 toes. The can is at the end of its road. And this is an updated 2-year, 10-year spread. And this is what I want you to see. It is lower right now. You'd have to go all the way back to the 80s when we were doing that last transition into a full debt-based economy controlled by the central banks. This is not good. We started talking about the 20 and 30-year inversion. Was it like December, January? So it should not be a surprise. And I said it always starts on the longer end and then works its way back. Now it's as bad as it's been since we were transitioning before. Why? Because we're transitioning again. We are transitioning again. And when we transition to the new debt-based system, has that really been good for you? Because back then, $9,500 was the average income. And a family of 4 could survive on that with one wage earner. Now you need 2. And if you look at the stimulus checks, what? that you got stimulus if you were under 150, or even this last one I think was 250. So does that mean, what does that mean? That means that the value of the dollar has gone down, down, down. That's what that means. And you can deny it, you can go into hopium, and this time is different and all of that. But the reality is the patterns are so much smarter than I am, than you are, than anyone is. And they don't lie. And they're telling you something extraordinarily nasty this way comes. When? I think we've already started down that path. I'm sorry, but I do. I really do. And traders who just want to survive sit on 5 trillion cash pile. Now, see, isn't that great? Because that means that they can deploy that money back in and support the stock market and support the bond market if they so choose to do it. But they're making more money in money markets, and they're not wanting to take that risk. Of course, what they miss, what it seems like a lot of people miss, is 1 trillion times 0 is still 0. I don't care how many dollars I have. I care what I can convert it into. And believe me, as soon as I get it, I convert it. Might be into food or water or energy or security or barterability or wealth preservation or community or shelter. I convert it. I don't want to sit on more dollars than I absolutely have to. And yes, I do. I run a business, so I have to sit on more dollars. But if all those dollars go, whoop, not going to matter to me because I have the gold and I have the silver. And it's happening. Now, they're showing you the interest rates, and they're showing you how much, and look at this, because this is 1920, the shortest recession in history. Oh yeah, things were certainly solved, weren't they? And look at, they parked their money. Have they deployed that? No, they haven't deployed it. Even though the markets have gone crazy, they haven't deployed it. That should be telling you something. The bond market indicates we are running out of time. Central banks are absolutely hell-bent on raising interest rates, even though they openly admit that doing that is not really going to tackle inflation. And as we've seen, and I've shown you in a number of other videos, like Mexico has been raising rates and raised them a whole lot higher and a whole lot faster than we have, and it hasn't done anything for inflation. It has not tamped it down. It won't, because it's a blunt instrument, and they created this mess. And just know we are running out of time, and I don't want you to be caught in that. So where do you hide? I mean, they're going to sit in cash. Where are you going to sit? It goes back to food, water, energy security, barterability, wealth preservation, community, and shelter. Get it done. That's where you hide, because those are all the things that you need, and put medicine in there too. These are all the things that you need to retain a reasonable standard of living. And that's the first thing that we really do have to make sure that we can do. And if you are sitting with wealth in the stock market or in the bond market or annuities or any of those fiat money markets that are outside of your control and are intangible, then I strongly encourage you to make sure that you have a truly diversified portfolio into good money. You do what you want, but that's the choice I've made. Because really, ECB is going to be extremely vigilant on inflation expectations. Expectations. Doesn't matter what's true. It matters how you perceive it. This is all part of perception management. And central banks are losing control of our inflation expectations. They've already lost control of the inflation. It's ridiculous. Transitory? No. I even said I think this is the beginning of the hyperinflation. It's going to get much, much worse. And it's going to get much worse here. Oh yeah, we're going to keep at it. We're going to keep... Okay. They just never learn. Doing the same thing over and over and expecting different results is ridiculous. You're not going to get different results. And this economy is growing globally I'm talking about. But hey, we can talk about the US or Great Britain or Europe or China or anywhere in the world. The economies are getting so much more fragile. And what are they doing? They're raising rates into it. But they better not let you own physical gold, because that is outside of their purview. As the Bank for International Settlement says, gold held at home does not run political risk. It is the only proven inflation hedge. It is the only financial instrument that runs no counterparty risk, the only one. So of course it makes sense that it would be dropping into this. And what I'm showing you here is the US, let's see, this is the dollar. So as the dollar is getting stronger, that's fiat money. Then the expectation is that the gold gets weaker. But what's really getting weaker is the spot gold market, the contract market, where you can create an unlimited amount of gold that does not nor ever will have to exist. Now, I just know that back around 2009, when I stumbled across or I found the data at the Bank for International Settlements, there were 62,000 ounces of derivative gold to 1 ounce of physical. You can do anything you want with the prices. Take advantage of them. That's what I recommend. Take advantage of them. Because all you're looking at here is the relative performance between two fiat money products that has demand in one place in the markets. That's it. Physical in your possession, that's a different story. Likely, and we can talk about this tomorrow with Eric, but likely the premiums have been going nutty because definitely more and more people have been buying. And I know that I'm showing you this, and I've shown it to you before, because I really, really, really want to hammer home how easy it is to create as much paper gold as you want. And cheap. 150 bucks controls what, about $1 million worth of gold? Cheap. But what you're also seeing is that this system is falling apart. Government bond markets are falling apart. That's the foundation. The foundation is now crumbling. When will it implode? Can't tell you the exact moment. But you ask me what I'm looking for? This is what I'm looking for. The con game is over. I would bet my life on it. I am betting my life on it. The con game is over because it is cheap and easy and legal to create as much gold that doesn't exist as the banks and especially as the central bankers want. Because the rising gold price is an indication of a failing currency. Yeah, buy a government bond. It'll pay you 3%. It'll pay you 10%. It'll pay you 100%. But 1 trillion times 0 is 0. And we are well headed towards 0 in purchasing power. The British pound, if the public in England loses confidence in the British pound, it is game over for everyone. It's the canary in the coal mine. I suggest you listen. Also, if you have not yet started your gold and silver strategy, please do yourself a big favor. Get it done. You gotta have a plan. They have a plan, and I'm telling you right now, we are closer to you needing that plan than ever before. I don't like what I'm seeing. I don't like it at all. It makes me very uncomfortable and really, really nervous. If you haven't yet done it, make sure you subscribe and hit that bell below. We'll let you know when we're going live, but you need the information that I'm putting out here. So if you haven't already, I'd suggest that you do subscribe. And this is without a doubt, and I seem to be saying that. I only used to say that every once in a while, but I'm saying it more and more often. This is an extraordinarily important video. You've got to get as many people as you possibly can to listen to this, to watch for it, because it is a clear indication of how close we are to collapse. Food, water, energy security, barterability, wealth preservation, community, shelter. Please get it done. And we're also happy to help you on the Beyond Gold and Silver channel, so we can meet you wherever you are to start this journey. But, how do you eat an elephant? One bite at a time. You have to get started. Please get started. I'm really, really, really concerned. So I'm going to ask you to please be safe until next we meet. Bye-bye.